Good morning from our global headquarters in New York. I'm Manus Crenny with Denny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Fed jitters. The S&P falls the most since January as markets brace for a hawkish pivot from Powell. Amazon gets an AI boost. The e-commerce giant posts the strongest cloud sales growth in a year. And Tesla cost cuts continue. Elon Musk axes most of the company's supercharger team. Good morning, Manus.
A very good morning, Danny. Stocks are nervous, are you? The consumer confidence tanked yesterday, but just take a look at Starbucks. There's a crisis out there in matcha latte land. This stock is literally getting demolished this morning. On a slightly more serious note, the consumer is pulling back. In China, sales are under pressure. A multitude of cuts come through from Citi, from Jefferies, and from Cohen. There was a monster flow into equities last week. If you remember, such a febrile week for equities and big tech, and yet $3 billion flowed into equities across institutions. Amazon also one to keep an eye on this morning. The retail side of the business perhaps not pumping on all four cylinders, but it is about cloud services. AWS really nicely doing it. $100 billion by the end of the year. Yields are, again, unsure of their footing. We had a hot ECI yesterday. The hedges and the CTAs are actually short into this Powell FOMC meeting. We are max short duration, according to Bank of America. So we're so squeezed, we're so short. What could happen if he doesn't rip the rug on rate cuts completely this evening? Crude is down by 1.4%. We debated this morning. I put it down to stockpiles being up for the fifth week in a row at 4.9 million barrels and a strong dollar, much more than the febrile narrative that we are somehow closer to a peace initiative from Israel joining the talks. That's a very febrile level to put into this for a drop of 1.4%.
Manus, it's important that this market is geared up for a hawkish Powell, but what could be the surprise? To get really hawkish, more than the market suspects, it would have to be a Powell that introduces the idea that they're agnostic on what their next move is, whether it's a hike or a cut. But as Steve Englander from Standard Charter writes, that he's going to still have a cutting bias because they don't want to push yields higher than they already are. Powell himself has said many times that he believes conditions are tight. He doesn't want to make them tighter. He doesn't want to make them looser. It's a very careful needle he needs to thread.
It's whether he keeps these insurance cuts alive. And we have hawked, this market has hawked itself so aggressively into this meeting. And if you think of where PCE is, and our next guest, Tim Graf, talks about this, PCE is pegged by the Fed to be at 2.6%. We're at 2.8%. We've completely lost the plot in terms of the disinflation narrative. That's perhaps paraphrasing on behalf of Tim.
Well, things like ECI certainly didn't help yesterday.
Yeah, they were tight.
Well, in favor of not paraphrasing our next guest, this is what he writes exactly, Manus. That the labor market and inflation has not changed sufficiently in recent weeks to suggest overt hawkishness or to bring additional hikes back on the table. That hurdle still seems very high, even if it's not an impossibility. Let's get to the man himself. It is Tim Graf, head of EMEA macro strategy at State Street. So, Tim, good morning to you. Thanks for joining us. Has this market then gone too far?
I think a little bit. I think it's similar in scope to what we saw at the beginning of this year when 6 or 7 rate cuts were priced, and that was a big deviation from the Fed's message. I think this is probably a little bit more realistic than that was in terms of taking most of the cuts out. But I do think we've probably swung a little bit too far the other way, as Manus brought up. The point about the Fed's inflation forecast is really important. They're not that far away from what they were suggesting inflation would be at the end of this year, and that's with 2 or 3 rate cuts in their forecasts as well. So I think markets, as they often do, got a little bit overly sensitive to recent news flow and have probably swung a little bit too far the other way.
But then that is the natural proclivity of markets, to take 2s over 5% and to really sort of push that needle. And as Bank of America said, we are max short duration into this. Some people are sort of saying, oh, the real juice will come in the minutes, because that's where there could be a real fracturing in the Fed and the debate about a hike. How high is the bar for State Street globally to a hike?
I think it's still pretty high, exactly because of that inflation narrative. Inflation has gotten stuck here. But again, it's not a million miles away from their own forecast, and it's making progress towards target. I think you'd really have to see the next few months really confirming the narrative from the first quarter, which we kind of went through this last year, where the Q1 data was also quite hot, and then it settled down as the year wore on, as residual seasonality wore off. I think there's still potential weight to come from shelter inflation and bringing inflation down. And so the Fed has time on their side, and that's the big variable for them. They can afford to be patient where markets maybe don't want to be or can't be. The Fed can be, and I think that's the message that will come through today, is not committing either way, really, but just committing towards watching things play out for a little bit longer.
The argument from folks like Mohamed El-Arian and Tim, though, is that there are cracks if you look for them. We saw some yesterday. We had consumer confidence come in much weaker. We also had a Dallas Fed Services survey. Also, that one was poor. Is the consumer starting to crack? And if it does that just get inflation back down to target? Or is it something much worse for this economy that the Fed needs to get ahead of?
It's hard for me to say that the consumer's starting to crack. When you look at the retail sales data and the consumption data from Q1 GDP, it still looks pretty healthy. But it's a really good point that the labor market, at the very least, has come back into balance. And that's where I think things like the quits rate released in the JOLTS data later today, I believe, that's where it's really important, because it shows that balance, that return to the pre-pandemic normal level of quits, which suggests that even though ECI yesterday was quite hot, the labor market being balanced does not necessarily mean you're going to have a wage price spiral from here. And I think the data yesterday suggests the danger of a wage price spiral that drives future inflation higher is still pretty unlikely. Prepared to be wrong on that. But right now, what I don't see is a labor market overheating and a consumer potentially in the future overheating. It's something that's much more balanced.
Tim, I want to assure you about the U.S. consumer. It is alive and well. Danny and I have been debating the price of a matcha latte. She's all in.
Manis will not let this go. Let me just say this here on the show, because Manis will bring it up at some point. I spent $10 on a matcha latte, but it wasn't at Starbucks, which is why Starbucks is doing poorly. I just need to get it out there, Tim, because Manis will bring it up today.
I am a bit obsessed.
You know what? Now that you say it, the Fed maybe does have to hike. That's just far too much.
You see, there's the rationale and the reasoning, the hysteria of the U.S. consumer, the hedonism of the U.S. consumer. On a slightly more boring and dry note, let's look at the Bund Treasury spread, because it actually blew out. And that's based, Tim, very clearly on the overpricing of cuts, perhaps from the ECB, and the underpricing of cuts from the U.S. There's a small turn in that, Tim. Do I need to reappraise the Bund Treasury spread?
I think so. I think it's at a fairly appealing level to buy treasuries. I mean, the inflation story in Europe is more benign than what you see in the U.S., but as you say, I feel like the ECB is adequately priced for the modest easing cycle that is to come. And actually what we saw from the growth data yesterday for Q1 in Europe is that it's not as bad as was feared. And so I do think there's room for that. You know, I've been a fan of U.S. duration for a little while, so take those comments with a grain of salt. It hasn't really worked the last few weeks. But nevertheless, real yields in the U.S. versus Europe, nominal yields, I think that spread does look attractive to narrow a little bit.
Well, that's the bonds in stock land, Tim. We have seen this repricing of not necessarily weak growth, but strong growth and rate cuts that don't happen sooner. And that's made this market move sideways. What breaks that? Because clearly earnings so far hasn't been enough to get us moving higher.
No, I think you need a couple of things for the U.S. to really start to underperform, and that is a reacceleration of inflation on the one hand, which I don't see as likely, as per the comments previously, or a really hard landing that not only brings rate cuts this year, but brings them aggressively, and you get some evidence of a slower U.S. consumer. If you don't get those, I think the path of least resistance is still for maybe a little bit further of this froth in the U.S. equity market to come out. That would be understandable. We got a little bit over our skis in Q1. But I still suspect that we're going to probably make new all-time highs in U.S. equities by mid-year, maybe a little bit after that, just given the resilience of those big cap names and how healthy their balance sheets still look and how their earnings quality is still the best in the world.
There you go. Finish with a flourish and a bid. Tim Graf, State Street, joining us. Let's see what the Fed has got to deliver, and Powell says this evening. Tim, thank you very much. Other stories trending on your Bloomberg terminal this morning. This is what we got for you. New York City police officers entered Columbia University's campus last night, arresting pro-Palestinian demonstrators who had barricaded themselves into the building. Columbia's president said she asked police to clear all protest encampments and maintain a campus presence throughout at least May 17.
The Senate has voted to approve legislation banning the import of enriched uranium from Russia. The bill now needs Biden's signature, and the White House has said it supports efforts to block Russian shipments. The Prohibiting Russian Uranium Imports Act would bar U.S. imports 90 days after it's enacted. Russia is currently America's #1 foreign supplier of the nuclear fuel.
Binance founder CZ says he'll remain a passive investor in cryptocurrencies. A court in Seattle sentenced him to 4 months in prison for failures that allowed cybercriminals and terrorist groups to freely trade the world's largest crypto exchange. Now, while the sentence was far below the 3 years the prosecutors had sought, the outcome closes a long-running probe for the Justice Department.
Daniel Loeb's investment firm Third Point says nearly half of its equity portfolio is now in AI-related names. That includes what it calls a substantial investment made during the first quarter in Alphabet. Third Point has also added positions in TSMC and the London Stock Exchange.
Coming up in the show, Amazon's strong growth for cloud offsets worse than expected sales outlook. More on the Amazon story.
And with Eli Lilly showing the power of weight loss drugs, Ozempic maker Novo Nordisk now takes center stage. No room for disappointment on that one. Here on Bloomberg Brief.
See considerable momentum on the AI front, where we've accumulated a multi-billion-dollar revenue run rate already. You've heard me talk about our approach before, and we continue to add capabilities at all 3 layers of the Gen AI stack.
Well, shares of Amazon are rallying in a volatile post-market session. Rising AI demand helped the cloud unit sales to post its strongest growth in a year, while the company's overall sales forecast, that disappointed. Charlie Wells steps into the Amazon AI business debate with us this morning. I mean, this was the huge focus of the earnings. It's about the size and the scale and the heft of AWS and what that will be.
Yeah, Manus, I mean, this was Amazon's show me moment for AI. So we've heard so much about these big tech companies talking about AI, but what investors really wanted to see was, do you not just have these cool tools, but are you actually making money off of them? And will you continue to make money off of them in the future? And yesterday on Amazon's first quarter earnings report, they were able to say yes. So the AI franchise sits within Amazon Web Services. Amazon Web Services revenue in the first quarter was up 17% from the same period last year. But what was really interesting yesterday and what was very important was executives for the first time attaching a multi-billion-dollar revenue run rate to that AI franchise. So that tells that future story that investors have been razor focused on, and it seems like Amazon should be rewarded for this.
Right, it's the difference between an Amazon and a Meta, where you say, okay, you have a lot of spend on AI, but is it really coming to fruition? Now, Charlie, we're going to have Blake Droesch of Emarketer on later to talk about the retail side of Amazon, but give us a little taste. How is that performing?
It was a little softer than expected. So what was really striking is the CFO of Amazon yesterday was talking about some consumer behavior at the e-tailer. Haven't used that word in a long time. And actually, it was softer than expected. And strikingly what he said was that consumers have been trading down on some products. So they've been spending less. It feels almost like an inflation story there. And interestingly, Amazon shoppers are actually buying more consumables, which these are things that need to be delivered faster. They need to be delivered more frequently. And of course, that cuts into profits.
And in terms of the other main tech beast, it is Tesla. And again, more changes here. We learned yesterday that they're axing the supercharger team. Now, that's a blow not just to Tesla, but also to the broader EV market. Why?
Well, look, this is a huge network, and a lot of the major car makers in the United States, Ford, GM, Rivian, had been planning to tap into this network. EV charging is crucial for people who are buying electric vehicles. And what we found is that Tesla is cutting almost all of this 500-person team. We know, according to a person familiar with the matter, this was a decision that Elon Musk took within the last week or so. And it's interesting because just last week, the company was talking about the growth of this supercharger network, but this is going to create confusion and potential chaos for large automakers who had been shifting to this Tesla network. They had been shifting away from another standard. They'd been sending their customers adapters to use in the supercharger network, and even some vehicles that are supposed to be delivered in 2025, those had this Tesla standard installed. So this creates a lot more confusion. Now, what Musk has said on Twitter is that they're going to be focusing on growth, but slower growth, and they're going to be focusing on making 100% uptime. So this is a big change. This is a slowdown, and American car makers are not going to like it.
Yeah, just looking at Tesla shares pre-market, we're down more than 1.5%. Not completely unwinding the Monday gain, but working our way there after a 5.5% loss yesterday. Charlie, thank you so much. Bloomberg's Charlie Wells there. Now to another auto company. Mary Barra has taken GM from financial ruin to profitability, reviving a company that some see as merely a relic of Detroit's golden age. She told Bloomberg Originals host and executive producer Emily Chang on why she's betting big on EVs and autonomous driving, technology she thinks will be crucial for the next era of cars.
We're still, as an industry, we're in the early days. I think what we're still seeing is battery chemistry, battery technology is still expensive. And because the vehicle is already a very expensive purchase for consumers, it's continuing to get costs down while we continue to improve the technology.
It almost feels like hype is slowing down. Do you feel like you're battling that, like a sentiment shift as well?
I think it was overhyped. And now it's probably underhyped. Mm-hmm. And the truth is somewhere in the middle. But, again, yes, growth has slowed, but it's still growing.
Mm-hmm. You scaled back some of the EV targets, mainly because of the battery manufacturing issues. Why is that still such a challenge?
We were making something new.
Mm-hmm.
I grew up in manufacturing, so I feel like we do have a lot of manufacturing expertise. But I think we took for granted some of the newer processes, and we will not do that again.
Yeah. Elon Musk has mocked traditional automakers for how long it took them to get into EVs. Was he right about that?
If I had a do-over, I would have, even though we were moving, I would have accelerated the pace. Hindsight's 20/20.
Tesla stock is up more than 1,300% in the last 10 years. GM is up like 13%. You have met or beat expectations 35 out of the last 36 quarters. So when you look at the stock, does it ever piss you off?
Yeah. It does. I mean, because but again, I can get mad about it and I can be upset and frustrated. And believe me, I have those moments. At the end, it's our responsibility. You can't go home and have a pity party.
And you can watch The Circuit with Emily Chang tonight at 6 p.m. New York time on Bloomberg Television, or stream it at 8 p.m. Eastern on Bloomberg Originals. Now, the bond market is nervous, Danny, ahead of this FOMC and the Powell narrative. We already know yesterday there was a hot ECI, Employment Cost Index. Interesting, reading BMO's research from Ian Nigan, he says that's retrospective and we're all putting a little bit too much emphasis on that, but that's not what the rest of the market thought yesterday, is it?
No, we have now just priced in only one full rate cut for the year, obviously very different from the dots. What kind of tone do we get from Powell? Maybe his aim today is to literally say nothing, don't move the market, and that will be a win.
That's not what we do every morning on Bloomberg Brief.
We move the market?
You do.
I don't think we have that power, but coming up,
she does.
We'll talk more of your top stories. This is Bloomberg Brief. I'm Danny Berger alongside Manish Cranny in New York. Manish, time for some of our front page news.
Yeah, and this story really is escalating across the world. We've seen multiple protests. This is the Washington Post writing about students across the globe joining the Palestinian protests taking place in campuses in Kuwait, in Lebanon, in Egypt, in Paris, in Australia, to name but a few. Now, this piles pressure on administrators and companies to divest from Israel. You're looking at pictures from the Yale campus there, Danny, but the Columbia pictures yesterday afternoon and evening were a serious escalation.
Right, students barricading a building for risk of expulsion. Of course, at the same time in the Middle East, Anthony Blinken is there in Israel. Now, next up, Mercedes has replaced its U.S. CEO. The company is facing aggressive campaigning by the United Auto Workers. He's not leaving the company. He's simply going to a different role. They're elevating someone else. Mercedes didn't give a reason why, but it is clear at the same time the UAE is holding a vote on unionizing a plant in Alabama. And again, it's the VP of Mercedes that's going to be named as CEO.
Now, the story of the day, in case you hadn't already listened into the first section, is about Starbucks. But the CEO there, I mean, the stock is being battered this morning, down 13%. It's a promise of a turnaround story from the CEO to speed up the service in the morning time and to make sure you get your matcha latte. Danny's a big advocate of that. And net income fell 15%. But this is about, I mean, I have a loyalty app for Starbucks.
Do you use it?
Yes, I do. But I got to say, there's virtual sacrilege against coffee in some shops.
Well, I mean, the coffee shop, the Starbucks I walk by, has this big poster outside with their fancy lavender latte. I've never seen anyone drink this thing. It seems like it'd be beautiful.
A lavender
latte. It's literally the lead of our story, saying that consumers are too price sensitive to buy a lavender latte.
If you arrive with a lavender latte,
but you wouldn't drink it? Come on, you'd be tempted.
I'd share a lavender latte with you for sure. That's the way that that's the way that we roll. Although, if you think about it, I mean, slow down at Starbucks, McDonald's under pressure.
Yes.
We only talk about the quality food and beverage sector in this show.
No, it's true. Consumers are under pressure. Speaking of which, we're going to talk about the Amazon consumer coming up. From our global headquarters in New York, I'm Danny Berger with Manish Cranny. Let's set your agenda.
Fed jitters, the S&P falls the most since January. This as markets brace for a hawkish pivot from Chairman Powell. Amazon gets an AI boost. The e-commerce giant posts the strongest cloud sales growth in over a year. And Tesla's cost cuts continue. Elon Musk axes the company's supercharger team. Ramifications not just for Tesla, Danny, but for the great EV dream. Good morning.
Good morning. I have good news and bad news for you this morning. The good news is that you indeed made it past April. What a difficult April it's been. Here's Amazon shares up 2.7%. But that's not helping the overall market. That's my bad news for you. Here we are down about 0.5%. The score on the board, April, U.S. stocks dropping more than 4% after 5 months of straight gains. So clearly something has changed there. You also saw yields move higher by 50 bips in April. It happened again yesterday, a move of about 6 bips. We're back above 5% on the 2-year yield. It certainly didn't help that we had that ECI coming in hotter than expected. You also had consumer sentiment weaker than expected. All of that feeds into a picture of a careful needle that Powell's going to need to thread today. Also not good news for the yen either. That hot data, we're at just below 158. But Tim Graf this morning from State Street Manis saying that the market has gone too far. You look at a thing like the employment cost index, he says that is backwards looking, and perhaps we need to rein in some of the bond market losses we've put into this market.
Yeah, well, certainly the market is already quite short, and that would be the view for a number of different houses. We are max short duration, according to Bank of America. The hedge funds and the CTAs have also lumped up and proverbially lumped up and looked large in the face of a more restrictive Powell. Is that what he will pivot to? Because PCE is not exactly careering lower. But again, this is what State Street, the point that Tim just made, is that they penciled in 2.6%. You are at 2.8%. You're all far too negative about the trajectory of the disinflation. And as you say, there are some cracks, fissures in some of the stories in the consumer.
Well, it's the K-shaped recovery. Jane Fraser was talking about it yesterday at their annual meeting. But as Steve Englander of Standard Charter says, Powell doesn't want to sound overly hawkish. He wants to keep the cutting bias. Powell has said before that things are restrictive. He doesn't want them to be more restrictive.
No, so I think it's just more a question of pricing in what is an insurance cut. Now, we talked about tech and we talked about the consumer, but as far as Amazon, and they've got plenty of both of these, it's rising in pre-market. It's got strong results. The first quarter revenue increased, but sales outlook for the period going forward trailed estimates. Let's dig into the Amazon retail side of the business. We've got Blake Droesch, Senior Analyst at Emarketer. So on the consumer side and on the delivery side, whilst it's not the main alpha driver of sentiment, it is a feeder to the advertising business. Your assessment this morning?
Yeah, I mean, absolutely. It's definitely not the sexiest part of Amazon's business anymore, but it really helps propel that flywheel. If you've got more and more customers making use of their Amazon Prime memberships to access free and fast shipping through Amazon, they're going to be using the website more. That feeds into their media business, and it all ties into, of course, their stellar advertising growth, which we saw this quarter.
Blake, if you look at how consumers were this quarter for Amazon, Andy Jassy, the CEO, said in the earnings call that as the results show, customers are shopping but remain cautious, and they're trading down on price when they can and seeking out deals. Now, the results for e-commerce were slightly weaker, but is this something that Amazon can ultimately capitalize on, or does it just mean that margins are too difficult for them in this type of environment?
You know, it's tough. I still do believe that Amazon is well positioned. We've seen since the pandemic that customers are getting the goods that they typically buy at the grocery store, at the pharmacy, online, and they're getting good prices and they're getting fast shipping. And I think that's a good value proposition for the consumer in any economic environment. Now, of course, Amazon has spent the last year or so really restructuring their business to operate more efficiently. So those retail margins, those e-commerce margins perhaps are a little bit stronger. And a lot of that has to do with restructuring their fulfillment structure to make it more regionalized. And that's not only making their shipping more efficient on the back end, but it's also really helping the consumer get the essential household goods that they're buying more frequently online much faster. And I think that it's going to enable Amazon to keep investing in the e-commerce business, operate more efficiently, and be able to have the activity on the site healthy, which again fuels that flywheel.
I've obviously got to just jump the Rubicon from the physical Whole Foods to the online delivery. They already have 40%. You make this very clear. They have 40% of the US delivery market. What goes through my mind is, how do you grow that without the regulator turning around and going, you're too powerful and you're too dominant?
Yeah, I mean, it's a good question, and it remains to be seen. Amazon, as you mentioned, our eMarketer forecasts expect them crossing 40% of all U.S. e-commerce sales for the first time in 2024, and the next largest competitor is Walmart. Amazon is 5 times larger than Walmart in terms of U.S. e-commerce sales. Amazon sells more in consumer electronics, one category alone, than Walmart sells for their entire U.S. e-commerce business. Amazon's also going to be more aggressive in going into categories that are large retail categories but have a low e-commerce penetration. We've seen this deal with Hyundai last year. It's a big category, auto, biggest category in retail. Very small e-commerce penetration. In terms of opportunity for Amazon to continue to grow their market share, that's a focus area for me. And then also grocery, second largest retail category overall, low online penetration, Amazon being very aggressive. I think, particularly in the grocery segment, if Amazon starts stealing market share there, I mean, we've already seen what regulators are doing with the Albertsons-Kroger merger. So I could potentially see it being problematic for them.
Blake, I'm about to contradict myself here because we talked about taking advantage of the consumer shopping down. But we've seen, Manus mentioned this earlier in the show, some of where the lower economic rung of consumers are places like McDonald's, Coke and Pepsi. We saw it with Starbucks. We also saw it with Nestle, that some of those businesses are feeling the pinch of consumers who don't want to spend more. But the overall economy is doing well because the wealthier among us are still spending. If Amazon is branching into new areas of e-commerce, does it behoove them to try to target that market, not the ones who want deals, who want discounts, but the ones who are still willing to spend?
Yeah, I mean, Amazon benefits from the fact that over 70% of the population has access to an Amazon Prime membership. And for that reason, their customer base is extremely diverse. They are also going back to this point of people purchasing more essential goods, essential household goods online. Health and personal care is the fastest growing segment of U.S. e-commerce by a long shot. These are parts of people's household budgets that they're going to have to buy no matter what. It's not a latte that you can skip out on. When you run out of toilet paper, you run out of paper towel, you need to replenish these items. A lot of the woes that we're seeing in fast food, in CPG, for companies like Nestle, consumers don't necessarily stop purchasing these products. They trade down, and Amazon is another thing that they've done last year is they've expanded their consideration set, so consumers who are looking to trade down can find cheaper options and still access that fast and free shipping. As far as expanding into other areas, I think this is it's a long-term play for Amazon. The things like automotive, for example, with this deal with Hyundai, they've also struck this partnership, so there's an AWS element to it. They're going to start putting Alexa in cars. This is long-term investment that I think goes beyond how Amazon is trying to meet consumers in this current economic environment as well.
As if Alexa watching me in my own household, she's going to be in the car too. She's going to follow us everywhere.
She's going to check her driving and give her points out of 10.
Oh, please don't do that. Blake, thank you so much. I'm still getting used to New York driving. Blake Droesch of Emarketer, thanks for getting up early for us. Okay, coming up, Eli Lilly showing the power of weight loss drugs. Now Ozempic maker Novo Nordisk takes the stage. There's no room for disappointment. This is Bloomberg.
Back in December, they were looking for 6, then 3, now 2 and 1. Market has to readjust. So this has been a huge change and a shift. It's actually taken it in stride. I'm not surprised April's been so tough. Look how strong January, February, and March were in the market. It almost got ahead of itself. So, the Fed's going to be data dependent. I think we've adjusted to 5% interest rates up here, and the economy's doing okay. So I bet they're going to continue to hold for a while. That's news to the market. It's got to adjust to that. I think we're in a good place, but I think the market's going to go sideways. You can easily have a 10 to 13% sell-off in a bull market year. So people have to be ready. This market could be choppy during the summer. We've got the election. The Fed's going to be data dependent.
Chris, I asked this question on radio. Cameron Kreis writes great stuff for MLive. He writes a column every day, and his first line today was, one of the basic principles of successfully navigating financial markets is that you should only date, not marry your positions. And the question I was asking is, what position should you date right now, and which one should you marry?
Alex, I actually heard you this morning driving in, listening to the radio, and that was a very interesting discussion. Because I'm going to make a shout out to my wife, Robin, 40 years this month of May. So commitment. I think you stay married. And I think I'm a long-term investor, Alex. So I'm going to buy the beta of the market and hold it. And I'm okay being married to positions. I don't necessarily believe in trading and trying to time the market. And I've learned that the hard way myself. And for our fund here, we've done very well by being invested through thick and thin. Maybe you flow a little bit, but you diversify the portfolio 70-30, you hold for the long term, and you stay married to your asset allocation. Don't worry about individual stocks.
That was the Callister CIO, Chris Ailman, speaking on Bloomberg yesterday. So Chair Jerome Powell may adopt a notably more hawkish tone when he speaks at today's Fed decision. Officials are poised to signal no plans for cuts in the near future and keep rates steady. Joining us now is Liz McCormick, Bloomberg chief correspondent for global macro markets. Liz, it probably doesn't help Powell that we're off the back of hotter employment cost index data, something that they like to look at for wage inflation. So what is the needle that Powell needs to thread when he speaks today?
Yeah, like that ECI number, somebody said it's not a good look for the Fed, right? That's a number they care a lot about. It was hot. Yeah, I think Chairman Powell, clearly he's going to, double down on how he signaled at the IMF meetings that, the data's not there. We don't have the confidence. But, Danny, I was talking to a fund manager from Vanguard yesterday about this, and he was saying, remember John Williams of the New York Fed in a recent talk was asked by a reporter, kind of, why would you raise rates or could you raise rates? And he basically said, like a good central banker, well, if inflation picks up, we would do that, just talking theory. And this Vanguard fund manager were saying, if Jerome Powell's asked that tomorrow, that's a tough question because, anything he says that doesn't sound definitively we're not raising rates, you're going to see a market reaction. So I think he does have a very tight rope. They love to have their optionality, but the data's not there for cutting. We're only priced for just 27 basis points of cuts this year. So anything hawkish, you could see less than a full quarter-point cut hike priced in this year. So that's going to be a tightrope for him to walk for sure.
I think it was quite interesting. We had a conversation with Tim Graf of State Street just a little bit earlier, and he reminded us, I think a solid, fresh reminder, the Fed themselves had penciled in PCE at 2.6% this year. PCE is running at around 2.8%. Now, I don't know what the PCE is going to do over the next couple of quarters, but the distance to target is not that far. So, you know, a lot has to go very wrong to really destabilize the trajectory, and maybe it will be sticky. Talk to me about the issuance. Everybody told us it was a rounding error in terms of the amount of bonds that would be issued in the quarterly refunding, but it's more nuanced than that, so give us the bow on top.
Yeah, and as you know, Manus, there's such a focus. It's important on our fiscal picture in the U.S. because the debt load is so high that any kind of rounding error still, you know, gets the market's attention. So, yeah, on Monday we saw the financing estimates. So, in aggregate, what the Treasury Department is going to borrow for the quarter. But this morning at 8:30 a.m., so there is some important stuff for the Treasury folks besides the Fed. We had their announcement of what they call the refunding announcement, where they'll tell exactly what they're going to sell for 3, 10, 30-year notes next week. But we're looking for those coupon issuance to stay stable. They raised them the last 3 quarters. Treasury has kind of signaled last time that it's status quo. We have high enough, but we're sitting at many auctions at record levels. So any nuance, they're going to probably announce the exact date of this new buyback program they're doing. And people were looking any indications on what they're going to do with bill supply, which is like their buffer security, right? If things are worse, they can sell more bills or less. People think they're going to cut bills. So there's a lot to look at 8:30 for us kind of bond wonks as well.
If there's a place to thrive for bond wonks, it is here on Bloomberg TV. Liz, Janet Yellen was speaking yesterday, and she said that she's concerned about where we're going with the U.S. deficit. I mean, strong words, and obviously you need Congress to get their act together to make any sort of progress alongside the White House, too. There's no sign that will happen, and yet when we got that, you know, rounding error, that thing that usually shakes markets on Monday, the reaction wasn't huge. So what have you been hearing in terms of the fear of this, the fear of the fiscal position of the U.S., and how it plays into whether traders are willing to buy bonds right now?
Well, I think people have gotten, let's say, very informed on all this data. So there was a teeny bit of reaction on Monday. Then, like you said, it went away because I think people were remembering that, what's more impactful for the market is the coupon-bearing debt, the notes and bonds. And I think the people were clear that, after all the increases that started in August, we're not going to see any more, so it's not as bad. But I will say, going beyond that, there's no one saying that anytime soon Treasury could reduce the size of these long-term debt issuance. And in fact, Barclays had a note yesterday talking about, you know, with the higher borrowing estimate on Monday, we just don't know how soon. They're thinking sometime in 2025 they might have to lift these long-term debt sales again. So I think Janet Yellen's point, everyone heard it. People are aware. I think it is, in a sense, factoring in moving what we call term premium up a little bit in the long end. So I think it's there, but there's so many other issues, like we're talking about what does the Fed do? Front and center is Fed rate policy. So, but I think it's looming in the background of people saying, yeah, this debt problem is a problem, right? And let's see if anything in Washington. We do have a presidential election, of course, coming up to see if anything changes in the policy.
Liz, thank you very much. And you've touched on a raw nerve there. Is there enough term premium to tempt the real buyers back in? That is a very, very big debate. Liz, thank you very much. Liz McCormick. Let's see what Powell says later today. Pivoting to the makers of the COVID vaccine, sales plummet. Pfizer looking to new medicines in cancer and infectious diseases to drive the revenue and return to growth. Can they? We've brought in our Bloomberg Intelligence Senior Pharma Analyst, it is Sam Fazeli. So, Sam, we're in a period of transition at Pfizer, out of COVID, not completely, but what and how do they replace the pipeline with significant new drugs?
Yeah, hi, Manus. The way that Pfizer management have characterized 2024 is that they call it an execution year. And that's what everybody's going to be looking for in the first quarter. As you rightly said, they're going to show a pretty awful-looking quarter-on-a-quarter basis, Q1 this year versus last quarter, because of the much lower sales of COVID vaccines, and the same for Paxlovid. So it's going to be pretty ugly in terms of the numbers. The question is, what do they say and how have they executed on the new drug launches? A drug for multiple myeloma, for example, a drug for kidney cancer, bladder cancer that they just recently, acquired from through their acquisition of Seattle Genetics. So these are the things that I think the market analysts are going to be focused on, and of course, hoping that they don't change their guidance for COVID and Paxlovid for 2024, which was, as they said, should be easily achievable.
Sam, we're also going to get Novo Nordisk earnings tomorrow, very early tomorrow. I mean, it certainly is a macro event for Denmark, considering how much is riding on Novo Nordisk, but we're in this period of increased competition and supply chain issues. Can Novo Nordisk keep the skies blue with their earnings?
Yeah, well, I don't know how the skies will be like in Denmark tomorrow, but the reality is that there's so much demand for these products that I think they'll be selling as much as they can make, which is what Lilly told us yesterday. They are still supply constrained. That might equalize in 2025, 2026 period, but they already raised so much yesterday. The question is, what will Novo do tomorrow? Are they seeing the same trends? And of course, let's not forget that yesterday Lilly showed us that of the people who are starting prescriptions, new to brand as it's called, they have the lion's share. Not significantly higher than 50%, but they are above 50% versus Novo's Wegovy. Of course, Novo has answers for this, but the question will be, how has that impacted? What are we looking for when we see the numbers from Novo tomorrow?
Yeah, I mean, they're already up 27% this year after a big run up last year. Sam, thank you so much. Bloomberg Intelligence's Sam Fazeli. Okay, coming up, we're going to get you set up for the day, some of the market moving events for you to watch. Did you know that there's an FOMC meeting that Powell will be speaking? That's the big one. We'll walk you through it. It's Bloomberg Brief. Danny Berger alongside Manus Cranny in New York. Okay, let's get you set up for your trading day. At 8:30 a.m. Eastern, we're going to get the Treasury's quarterly refunding announcement. Then we're going to get other key economic data. That includes ISM manufacturing, JOLTS. Those come out at 10 a.m. And then you get your main event. The Fed announces its rate decision at 2 p.m. Eastern. Then we'll get Chair Powell's news conference at 2:30 p.m. Tune in for that. The surveillance team will be carrying you through that coverage.
Yep. What is the recalibration that Powell will intimate? Now, when it comes to equities, we've been talking about it through the morning. Okay, we've been having a little bit of a giggle, but Starbucks fell for the first time since 2020 on half of deals and lavender lattes. They just weren't enough to entice you in. Danny Berger did, I have it on good authority, have a lavender latte. When it comes to Pinterest, it's up 18%. This is rocking and rolling. Sales, user growth surpassing everything that the street had pinned in. And finally, advanced micro devices really under pressure this morning, disappointing on the forecast on their AI processors. Danny.
I don't know where you get your information from. I have not had a lavender latte. I have not. It's a matcha latte that I spend their money on, which prompted Tim Graf to say maybe the Fed does need to hike. Maybe he's got a point. But that is not what we're expecting to hear from Chair Powell today. He doesn't want things to be more restrictive than they already are. He needs to say we're not going to hike, and maybe we'll cut at some point.
It's about keeping the dream of an insurance cut alive or two. And that is what the bond market, we are so short into this. Surveillance is up next. Danny and I are off to get, what, matcha lattes?